Silver just crashed, harder than it has in 15 years. Since 2011, investors are panicking. Money is leaving the metal in record amounts, but hidden inside the chart, there is a signal almost no one is talking about. A signal that has appeared before, right before silver turned around. Is history about to repeat, or is this the start of something much worse? The answer is buried in one number, and by the end of this video, you will know exactly what it means. Welcome back to John Edge. Before we go further, let's slow down for a moment. If you are new here, think of this channel like sitting down with someone you trust, someone who explains the economy the way a good friend would explain it to family, plainly, honestly, without the noise. And if you have been with us for a while, you already know why this matters. Now, a small favor, not for us, but for yourself. If this channel has ever helped you understand money a little better, helped you feel a little less confused about what's happening in the markets, please take 2 seconds and press that subscribe button. Think of it like keeping a good newspaper delivered to your door every morning. You don't want to miss the next issue, especially not this one. And tell us something in the comments. Where are you watching this from today? We have viewers from so many different cities, different countries, different time zones. It's always good to know who's on the other side of the screen. Now, let's get into it. Silver has just gone through one of the worst months in its entire modern history. Not a small dip, not a quiet correction that fades in a few days. This is the worst monthly performance for silver since September 2011. 15 years. That is how far back someone has to look to find a month this bad. In just 30 days, silver lost more than 22% of its value. To put that in perspective, that is not the kind of move that happens during normal trading. That is the kind of move that shows up in history books, in economic case studies, in the notes that serious investors keep for the rest of their careers. So the first question anyone should ask is simple. Why did this happen? There are 3 forces working against silver at the same time, and understanding them is the first step to understanding everything else in this story. The first force is the US dollar. It has been getting stronger. When the dollar strengthens, silver, which is priced in dollars, becomes more expensive for buyers using other currencies. That alone slows down demand. The second force is rising Treasury yields. This is where it gets important for anyone thinking like a business owner or an investor. When yields rise, it means government bonds are paying more interest than before. Silver pays no interest at all. It just sits there. So when bonds start offering a real safe return, money that was sitting in silver starts asking a simple question. Why am I holding an asset that pays nothing when I could be earning steady interest somewhere else? That question, multiplied across millions of investors and funds, is a big part of why silver has been bleeding. The third force is the Federal Reserve. The market believes the Fed intends to keep interest rates high for longer than people expected. That belief alone is enough to push more money out of metals like silver and into interest-paying assets. Put these 3 forces together, a stronger dollar, rising yields, and a Fed that refuses to soften its stance, and it becomes clear why silver had such a brutal month. This wasn't random. It wasn't panic without a reason. It was math. Cold, simple math playing out across global markets. But here is where the story gets more interesting, and where most people stop paying attention too early. Look closely at who is actually selling silver right now. Data on speculative positioning shows that net long contracts, bets that silver will rise, have fallen sharply, down to around 11,700 contracts. On the surface, that sounds like a wave of people betting against silver, but that is not quite what is happening. There is no clear evidence of aggressive new short-selling building up underneath this market. In simple terms, this is not a crowd of new traders betting silver will fall further. This is mostly tired, exhausted long-term holders finally giving up and stepping away, taking whatever profits they still have left. That difference matters more than most people realize. A market being abandoned by exhausted buyers behaves very differently from a market being actively attacked by aggressive new sellers. One type of selling naturally runs out of energy. The other type keeps going until the attackers decide they are finished. So the real question is not just, how bad was this crash? The real question is, which type of selling is this? And what happens next when it runs out of fuel? That question leads directly into the next part of this story, the technical battlefield forming right now on the silver chart, and the hidden signal that could decide everything. Right now, silver is sitting in a very tight space, between $57 and $60, and it has stayed inside that narrow box for several trading sessions in a row. At first glance, that might look boring, just sideways movement, nothing happening, but that is exactly the mistake most people make. A market that has compressed into a tight range is not a market doing nothing. It is a market holding its breath. It is waiting, gathering energy, and when it finally moves, it tends to move fast and it tends to move hard. So the question becomes, which way does it break? Start with the bullish path because there is a real one here, not just wishful thinking. If silver manages to push back above $60, something important happens. The door opens towards $63. That number is not picked at random. It lines up with a descending trend line, a line that has been capping silver's rallies for weeks. If price finally punches through that line and clears $60 with real strength, it would be the first solid proof in a long time that buyers are stepping back in with actual conviction, not just slowing down the bleeding. That would be a meaningful shift, a signal that the selling pressure is finally losing its grip. But now, look at the other side. Because ignoring the downside would be dishonest, and this is not a story built on hope. If silver breaks below $57, the picture turns dark quickly. The path opens toward the $53 zone and potentially all the way down to $50. Sit with that number for a second. $50 is not a level anyone wants to hear mentioned casually, but it is on the table, and anyone serious about protecting their money needs to have a plan for that scenario, not just a hope that it never happens. So there it is, two sharp opposite paths, a market balanced right on a knife's edge. But here is where something strange starts to appear, something buried inside the chart that the loud, panicked headlines are completely missing. Look at the RSI, the Relative Strength Index, a tool that measures how overheated or oversold a market has become. Right now, silver's RSI is sitting deep in oversold territory. That much is expected after a crash this severe. But there is something else happening at the same time, something called a bullish divergence. Here's what that means in the simplest possible terms. Price is making new lows or testing recent lows, but the RSI is not following it down. The RSI is refusing to make a new low of its own. Think of it like this. Imagine someone pushing a heavy cart down a hill. At first, the cart speeds up every time it's pushed, but eventually, no matter how hard the push, the cart barely moves faster. The pushing continues, but the force behind it is fading. That is exactly what a bullish divergence looks like on a chart. The sellers are still pushing the price down, but the momentum behind that push is quietly running out of strength, even while the price itself hasn't turned around yet. It is one of the most closely watched signals in all of technical analysis. And right now, it is sitting quietly underneath silver's crash, almost unnoticed by anyone just watching the headlines. But here is the part that needs to be said clearly, without exaggeration. This is not a green light. It is not a guarantee that silver is about to bounce back. Oversold conditions, and even bullish divergences like this one, can drag on for a long time before anything actually changes. Sometimes they resolve into a sharp reversal, and sometimes they simply fade away, ignored, while price keeps falling anyway. So the chart itself is offering two competing stories at the exact same time. A dangerous breakdown path below $57, and a quiet, fragile signal of exhaustion sitting just underneath the surface, hinting that the sellers might be running out of ammunition. Two forces, pulling in opposite directions, and silver sitting right in the middle, refusing to pick a side. Yet, there is one more number though, one that history shows tends to move first, before silver even makes its decision, and it is telling a story of its own, one that very few people are watching closely enough. There is a number that most silver investors never check. Most people watching the price of silver on their phone don't even know it exists. And yet, this single number has quietly predicted silver's next move, over and over again, for years. It is called the gold-silver ratio. In simple terms, it measures how many ounces of silver it takes to buy 1 ounce of gold. When the number goes up, it means gold is being favored over silver. When the number goes down, it means silver is starting to win back attention from investors. Right now, that ratio is elevated, sitting near its recent highs. And even though it has pulled back slightly in the last few sessions, it looks ready to push toward new local highs very soon. Here is what that actually means, translated into plain language. Investors are choosing gold, not because they believe gold is guaranteed to rise, but because in a moment filled with a strong dollar, rising yields, and a cautious Federal Reserve, gold feels safer, more stable, less risky to hold. Silver, on the other hand, is being treated the way a nervous investor treats anything volatile, as the riskier cousin, the one you step away from until the storm passes. Picture it like this. Imagine a storm rolling into a small town. Most people run toward the strongest, most solid building they can find. That building is gold. Meanwhile, silver is standing outside in the rain, waiting for someone to notice it again. And here is the detail that changes everything about how this story should be read. Until that gold-silver ratio starts trending lower, silver is very unlikely to meaningfully outperform gold. It doesn't matter how oversold silver becomes. It doesn't matter how tempting that bullish RSI divergence looks on the chart. As long as this ratio keeps climbing or even just stays elevated, silver remains the neglected metal in the room. This is not a small technical detail. This is the tiebreaker. Historically, this ratio does not follow silver's price. It leads it. That means if someone is trying to guess where silver goes next, watching silver's price chart alone is actually the wrong place to look first. The real clue shows up in this ratio, before silver even reacts. Think about what that means for anyone trying to make a serious decision right now. Two paths were already laid out: a breakout above $60 or a breakdown below 57. But layered underneath both of those paths is this ratio, quietly deciding which one is more likely to actually happen. If the ratio keeps climbing, it adds weight to the bearish path. It suggests investors are still not ready to trust silver, no matter what the RSI is whispering underneath the surface. But if the ratio suddenly starts to roll over, starts trending down for the first time in weeks, that would be one of the strongest signals available that capital is finally rotating back towards silver. That capital shift tends to happen before the price catches up, not after. So right now, the smartest thing anyone can do is stop staring only at silver's price chart. That chart is only telling half the story. The real answer is hiding in the relationship between two metals, playing out silently while most headlines focus entirely on the crash itself. Gold is currently wearing the safety vest. Silver is still standing in the rain. And nobody rings a bell when that finally changes. But there is one more piece to this puzzle, one that has nothing to do with charts, ratios, or technical signals at all. It comes from something that happened this very week. A piece of news buried far outside the financial headlines. A story about a company quietly making a decision that reveals exactly how serious operators are treating silver right now, even while the world calls it a disaster. And what that company chose to do might be the most telling clue of all. While most investors were busy watching the price of silver fall, something unusual was happening quietly, far away from the headlines. A publicly traded company called Hyperscale Data, trading under the ticker GPUS, released a disclosure this week that deserves far more attention than it received. The company reported that its combined holdings of Bitcoin, cash, restricted cash, and physical silver totaled approximately $16.7 million as of late June. On its own, that number might not sound remarkable. But here is the detail that makes it extraordinary. That $16.7 million figure represented roughly 117% of the company's entire market capitalization. Read that again. The hard assets sitting on this company's balance sheet were worth more than the company itself was worth on the stock market. Think about what that actually means. Somewhere, a business exists whose Bitcoin, cash, and silver holdings alone are valued higher than every share of its stock combined. That is not normal. That is the kind of disconnect that shows up rarely, and when it does, it tells a story worth examining closely. So what is really going on here? It could mean the market deeply distrusts the company's core operating business. It could mean investors have written off its future almost entirely, focusing only on risk. Or it could mean there is a genuine gap between what this company holds in reserve and what the market is willing to pay for its stock. Most likely, it is some combination of both. And the numbers behind that skepticism are not subtle. The company's current ratio sits at just 0.53. In simple terms, for every $1 of short-term debt coming due, it has only 53 cents of liquid assets available to cover it. That is a serious liquidity strain, the kind that keeps finance teams awake at night. Its debt-to-equity ratio sits at 1.17, meaning the company is carrying more debt than it has equity backing it up, and the stock itself has been brutal to hold. Down nearly 89% over the past year, down another 37% in just the last week alone. This is not a healthy company by any conventional measure. That needs to be said plainly, without softening it. So why does any of this matter to the silver story at all? Because of what this company chose to do, despite all of that financial pressure. Instead of liquidating its hard assets to patch the liquidity gap, the company kept accumulating. Between late June alone, its subsidiary purchased nearly 50 additional Bitcoin on the open market. It continued holding 10,000 ounces of physical silver on its books, And at the very same time, it was expanding aggressively into artificial intelligence infrastructure, securing a $120 million reserve for a data center campus, acquiring additional land, and signing a master services agreement valued at over $1.2 billion with a cloud computing partner. This is the twist buried inside the numbers. A company under genuine financial strain with weak liquidity and rising debt was not retreating into cash. It was doing the opposite. It kept its Bitcoin, it kept its silver, and it kept building, even while its own stock price collapsed around it. That is not the behavior of an operator hiding in fear. That is the behavior of an operator choosing hard assets as insurance, even while its own equity story remains shaky and uncertain. It raises a bigger question that reaches far beyond one struggling company. If businesses under real financial pressure are still choosing to hold silver and Bitcoin rather than sell them off, what does that say about how seriously hard assets are being treated behind closed doors, even during a month when the headlines call silver a disaster? None of this changes the technical picture already sitting on the chart. It does not erase the risk of a breakdown toward $50. It does not confirm the bullish divergence will actually resolve upward. And it does not override a gold-silver ratio that still refuses to favor silver. But it adds one more thread to a story that is far more complicated than any single headline suggests. A historic crash, a fragile technical signal quietly forming underneath it, a ratio still leaning against silver, and now a struggling company choosing to hold on to the very metal everyone else is running from. 4 signals, 4 different angles, all pointing to the same unresolved question hanging over silver right now. And the answer is still being written, one trading session at a time.